Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, welcome back to the Wade Borth Podcast. Today, I have a super special guest. His name is Jacob Vanderslice, right? Jacob, is that how you pronounce your last name? That sounds good. So Jacob is a principal at VanWest Partners, which is a Denver-based real estate investment firm focusing on acquisition and management of self-storage units. And this is the part that caught me. I'm like, I hadn't talked to anybody that does a lot of self-storage. So this is kind of exciting. And I'm excited to bring this to those people that listen to my podcast that are open to that idea. So
nothing more exciting than talking about renting out a bunch of steel boxes, right?
Yeah, exactly. Although if there's money to be made out in renting out steel boxes, then let's talk about that. That sounds like fun. So
that's right. Well, before we started recording, we were talking about making money off ice vending machines. So there's money to extract everywhere in the world.
Yeah, there's we did a podcast a while back with my marketing, the gentleman that does my marketing, and we titled it "The riches are in the niches." Right? If we can find those little areas that most people would not venture into, or have a bit higher barrier to entry that they don't want to get into because they don't want to get educated, so on and so forth, there's a tremendous opportunities to make money and make really good cash and cash flow just by doing some studying and thinking, expanding your mind a little bit. There's a book, the Infinite Banking Concept by R. Nelson Nash is where I really focus my efforts on and what I believe in. And in there, he talks about imagination. He says imagination, the lack of imagination is what really holds people. And that imagination is one of the most powerful tools you can have. And so I'm a firm believer that if you can just think of something that's a little bit different and a little bit, way that's going to fit who you are, because it has to fit who you are in order to make those dollars. So again, using the imagination is a powerful tool. So, and in the bio I got on you, Jacob, it was talking that you and your partners, well, first you have $195 billion, $195 million in real estate assets. Is that correct?
Yeah, we have to update that. It's gone up a little bit. We have to update our podcast deck, but yeah.
So about double that with the price of real estate.
Around about 235 right now. Yeah,
235. So that's cool. And then one thing it says, you guys are driven by commitment to delivering an expertly executed and adaptable strategy. And I have that circled in big red. I'm like, I need to know more about that. Could you just maybe expand on that a little bit? What you're saying about that? Or?
Yeah, we've been investing in real estate full time since about 2006. And we have pivoted many times based on what the market's been doing. So we got started doing single family fix and flips. We've done over 1,000 of them all over the country. And that really started to kind of dry up in about 2015, 2016, believe it or not, and really dried up, starting the last 2 or 3 years. So we won that business about 2 years ago, and starting 6 years ago, we got into the self-storage business, and we started off with ground up development, and we thought it was a nice complement to our transactional single family business, buying, making better, and selling over and over again. It was more scalable, repeatable, durable. So we started off with some development projects here in Denver, and then we expanded into the Midwest, the Milwaukee market. We went over there in about 2016 and kind of kept going. So most of our deals were done through single asset syndications leading up to about middle of 19. We did our first storage fund in 19, closed that fund in 20, launched a new fund in early 21. We closed that fund Q1 of this year. And we're launching our third fund very shortly here, all focused on self-storage. So self-storage has been a good business for us. It's our main line of business now. We spend 95% of our time on self-storage. We'll do some little, side deals in the commercial space here in Denver, kind of smaller projects when they show up. But by and large, it's self-storage.
So why self-storage? I mean, there's 1,000 other avenues you could have gone down. Why the self-storage avenue?
Well, we like the
what was presented itself.
Yeah, one aspect. I mean, I was investing in real estate through the financial crisis, and I remember that like it was yesterday. And I wake up every day and think about what's the next event that's going to cause a downturn and how are we going to see that coming? And we had studied self-storage for a while, and the asset class is very historically resistant to recessions. It was one of the best, if not the best, real estate asset classes as far as performance goes during the financial crisis. It had the lowest loan default rate. And it was one of the only asset classes during the financial crisis with positive revenue growth. When everything else was going down, self-storage was kind of hanging in there and going up a little bit. And it performed extremely well during COVID, and it's still going well. So it's a good downside protection vehicle that kind of just performs in the peaks and troughs. We also like it because of the granularity of the revenue streams. So we've got thousands of customers paying us between, $50 to $300 a month. And the chances that any one of them are going to roll over in volume at the same time are pretty low. Unlike a retail tenant that might be paying you 25,000 or 30,000 a month, they stop paying. It'll take you a year to get them out. You have to spend a lot of money to re-tenant the space. In self-storage, you don't have that risk. And the other reason we like it is the revenue streams are very dynamic. So we can we can change real time and respond to real time supply and demand changes at the submarket and the facility level because all the leases are month to month. So for example, if you have a unit type that's getting full, you can raise rates on that incrementally with a 1 month notice and probably not lose any customers. And likewise, if you have a unit type that's not at the occupancy you want it to be at, you can drop rates below market, fill those units up, and then kind of tweak your revenue management over time.
Right.
So the granularity of the revenue stream, the historic resistance to downturns, and the dynamic revenue management are kind of three of the reasons we like storage.
Gotcha. And I've got a lot of, clients that are in real estate, or I've had conversations with other real estate people. And one thing, I think there's a real tendency to want to let the tax tail wag the dog. But, I'm assuming that's not where you guys are doing it because it's not about depreciation. It's not, it's really just about generating revenue and cash flow. Is that fair to say? Or, I mean, there's obviously some benefits to it, but it's not
It
to
is,
be.
yeah. There's the depreciation certainly offsets your AGI. If we pay a 10% return, investors might pay taxes on 3% of that, right? So there's some advantages there.
Mhm.
But in our careers, I mean, we've made a lot of mistakes, and we've certainly been guilty of the tax tail wagging the dog on a couple deals. So mainly in 1031s, right? You're doing a 1031 exchange. You got a big tax bill if you don't find a replacement property, and you might find yourself in a position where you're buying a deal that you otherwise wouldn't buy organically just to defer that tax liability. So
Right.
we're all guilty of that here and there, but it's something to watch out for sure.
And you've obviously dealt in the real estate market for a while. That is a thought that I think has a tendency to creep into people's brains, is that, they get more worried about the taxes and they're not worried about revenue and cash flow, and they let that kind of lead their way. And hopefully, obviously what we teach through the infinite banking concept is, the idea that you want to control the banking function in your life, right? And once you have that bucket of money and you can control the banking function of your life, then it's like, how do we put that money to work? In Nelson's book, he talked about money's like water. It has to flow, right? And if it's not flowing, it becomes stagnant and evaporates. And so part of this conversation, or a lot of the conversations we're trying to provide to the customers, is like, what can we do to take our money and have it flow and have it work for us versus storing it? Because banks don't store money. All the big institutions, all the wealthy people in this country don't store money. They put it to work and they have that money and now generate cash flow back to them, or at least a revenue stream coming back to them to serve their purposes.
My definition of wealth is recurring, durable, repeating revenue streams.
Durable.
And I've got a brilliant tax strategy for everybody. If you want to save money on your taxes, don't sell your assets.
Yeah, there you go.
Right.
So,
Just
yeah.
cash flow.
Yeah, just cash flow. So I like that because, like I said, it is one of the things that we want to discuss, and that's important to us is, how people think, right? It's that imagination thing that we talked about. And what do you see as far as like your clients' biggest hurdles when it comes to investing in either real estate or self-storage type of units? What do you see as like their biggest hurdle, or what's the thing that really holds them?
Are you talking about hurdles for our investor base on whether they proceed with an investment or not?
Yeah, or just, people that you talk to in general, like if my clients are coming to you or somebody's coming to you.
People in general who are thinking about investing in real estate and aren't, I think the worst thing you can do is not take risk and not take action. It's really easy to listen to podcasts, read books, go to classes, go to seminars and learn. But the best way to learn is to go out and do a deal. There's no perfect deal out there, right? We have never bought a deal where, I want to say never, but we have rarely bought a deal where we're like, oh, we just stole that, right? We got a
Yeah.
huge discount on it. It's going to be a home run. We've bought deals that, we've mitigated the downside and quantified the upside. But I think the path to success is got to start with some element of risk. And if you go out and do your first deal, it doesn't go perfectly. Hopefully you don't lose too much money, if any, but if it doesn't go well, you learned a lot, and you learned a lot more than you would have sitting in a seminar or reading a book.
Right. So when you say go out and do their first deal, what are they really looking at having to, and again, it probably changes every deal that you do, but I mean, Are you talking, they're having you plunk down 100,000, $200,000? What do deals look like in this realm? I mean, what is they're actually out of their pocket? What do they have to be willing to say, "Hey, I'm gonna put this money to work and see if we can either educate myself or find a good deal that can start to cash flow."
Yeah, I mean, if people have been thinking about buying a single family rental and they can't find the perfect deal, that's one thing. Most people, when they buy their first rental, they're going to self-manage it and kind of learn the ropes on their own. But as it relates to self-storage, really, there's three ways to participate in the space. One way is you go hire a broker and you buy your own storage facility. You learn how to run it. You hire an operations team, a call center team. You put up a website. You probably do some capital improvements to it, and you might make a little more money doing it that way. But the ROI on your time might be questionable, right? If you have a full-time W-2 job, it's just going to be a lot of time and effort to kind of do your first deal. So that's one way, is go out and buy a storage facility. Another way is to buy publicly traded REIT stocks and self-storage, like Extra Space or CubeSmart. Um, I think the singular advantage in owning a stock versus investing in a private vehicle is you have more liquidity. So you could sell your stock tomorrow and get a wire transfer to your Schwab account. But with that being said, you don't enjoy any of the benefits of depreciation. And, it goes up and down by the day. And the third way to participate in the space is to invest in private vehicles, either in a syndication or a fund. And sponsors like us, there's a lot of us out there, we'll do one of two things. We'll do a single asset syndication, which is typically one LLC in one deal. You raise capital for that, buy the property, you make distributions to investors. Eventually you refinance or you sell. They all get a K1, they get their return of capital and the other vehicle out there is a fund. And a fund is basically identical to a syndication, but a fund is a collection of assets. While we do both, we generally gravitate towards the fund structure. And the reason we like funds is almost picture a mutual fund of self-storage properties, right? A mutual fund, you've got all these different buckets of stocks. They kind of balance each other out. So inevitably in a 10 property self-storage portfolio in a fund structure, in a given time, you might have one or two deals that are behind forecast, but those are propped up by the other 8 or 9 deals that are ahead of forecast.
Right.
So a fund offers a little more geographic and cash flow diversification than a single asset syndication does.
Right. So do they have to be an accredited investor to do that, or is that something that?
Yeah, in our fund vehicles, they do. There's two different types of designations out there that sponsors will typically do a capital raise under. One is a 506B designation, which means they can accept a certain number of unaccredited investors, but they're only allowed to raise capital from their existing network. So they couldn't go do like an email blast or,
Gotcha.
a mass webinar or something to raise money. The other designation out there is a 506C, as in Charlie designation. And that vehicle allows sponsors to widely market the opportunity. But the flip side of that is every investor has to be accredited, and they also have to prove their accreditation, which is a pretty simple process. And for those of us who don't know what accreditation means that are listening, accreditation is simply you're either worth $1 million outside your primary residence, or if you're single, you make 200 grand a year and expect to make 200 grand a year for the foreseeable future. Or if you're married, that threshold is 300. So
Okay.
you can be accredited under either the net worth category or under the income category.
Right. Okay. Well, that actually, one of the key phrases I use is that there's no deals in the insurance industry. That's the industry we work in. But I think it's that way in every industry, right? If you want to protect yourself from the downside, you're having to give up something on the other side. And it's all about what's balancing what's best for you. But just understand that rarely do we ever find a true deal in
Yeah.
this world.
Yeah.
Um,
The complete elimination of risk is almost impossible.
right.
Yeah.
And risk is something that, what we try to do in the insurance world is we try to really mitigate risk. We try to really get it off to somebody else that knows what they're doing with that risk. Where a lot of people don't understand the risk that they take, right? If they're using all their time to do a deal, or if they're using risk can show itself in a lot of different ways. It doesn't have to just necessarily be in a monetary way, right? So a cost of time, that's acquisition cost. That can be huge, and people just don't put any value on that, or the use of their money for a long period of time. Inflation's a huge risk right now that people aren't recognizing that, if you don't recognize that risk, it's going to eat you alive. And, I can see it in the self-storage business, really in the real estate business, that does have a bit of a hedge against that unknown of where inflation is going to take us.
Yeah. I think hard assets that produce cash flow is a great inflation hedge. I mean, there's certainly some validity to the thesis that I'm going to sit on cash and wait for an opportunity. But in this environment, if you sit on your cash too long, in a year, your cash is not worth what it was a year ago. Whereas if you deployed that cash into an asset that produces cash flow, typically when inflation kicks up, hard assets go up in value. And so do rents, and so does that revenue stream. And
Yeah.
I'm obviously biased, but especially in self-storage, all of our leases, as I mentioned earlier, are month to month. So as inflation continues, our rental rates are going to go up, as opposed to, let's say you do a triple net industrial lease to Amazon and you lock in their rate for 10 years with some escalations. You might have signed that lease in, late 19, but their lease is locked in. They're going to pay the rent they're going to pay for that entire lease term. I would venture to say they're now below market, right? Just given how much inflation has kicked up. So inflation may not be a bad thing for real estate or especially for self-storage, but one thing that we're concerned on in our business specifically is our operating expenses are going to increase, right? Our revenue is going to go up, but we're going to have to pay our people more. Our utility bills are going to increase. Our vendor bills are going to increase. And another concern we have right now is the rising interest rate environment. So cap rates and interest rates are correlated in some way, depending on who you ask. But what's kind of scary right now is we've seen a substantial increase in interest rates, and we're seeing cap rates still compress, which doesn't make sense. And some economists are saying that's going to continue. And if you do the math on it, how can rates continue to go up and cap rates continue to compress? Meaning you're buying a deal for a lower yield on cost than you were a while ago, and your cost of capital to finance that deal is increased. And eventually that model breaks. It hasn't broken yet, but we're certainly watching to see how that manifests itself.
So what's the downside if that model, quote unquote, breaks, like you're saying? I mean, how does that affect you guys? Where's your downside protection in something like that?
Well, as you know, commercial real estate trades on a multiple of the income stream it produces.
Right.
And the higher multiple of that income stream, the lower the cap rate. So we're seeing Class A stabilized infill self-storage facilities trade at 3.5 or 4% cap rates. Well, if your interest rate on the debt that you're using to buy the property is higher than the cap rate, you're gonna have a problem. So it's not affecting us yet because most of our portfolio has got 10-year fixed debt. So we're not at the mercy of having to refinance anytime soon, which is kind of the perfect storm. We've got long-term cheaper debt than it would be today. Don't have to refi if we don't want to. Our revenue's going up. But on our new acquisitions that we're making this year, that's something we're looking at very carefully. What is the risk of if we're buying a deal with bridge debt, for example, with the intention to refinance at stabilization, what are we underwriting interest rate wise on that takeout loan? And that's been increasing a lot the last quarter or so. I'm sure we're carrying a 4% rate on a takeout. Now we're carrying between 5 and 5.5, and kind of stress testing that deal to make sure it still works.
And it still works right now with all the conditions that are present.
It still works right now, but again, that's an element of risk, right? One thing I mention often about our models and our underwriting is it's always wrong, right? It's either wrong in the right way or the wrong way, but a pro forma is never going to be exactly like the deal goes, right? It's going to do better or worse. It's not going to be to the penny of what you thought it would be. So that interest rate risk is definitely something that we're aware of and we're digesting and trying to be conservative on.
Gotcha. Gotcha.
Yeah.
So, one of the things I talk about when people get into the space of taking control of their banking function through the infinite banking concept, we talk about it takes three things to be successful. And I'm thinking it's probably going to be in your neck of the woods about the same thing too, is that it takes time, it takes money, and it takes discipline. If you try to shortcut any of those, because what we're doing is we're teaching people a lifelong, really an intergenerational process of how to, take control of the bank function, have this generational wealth transfer. That's really our whole objective, right? And I imagine it's probably along the same way with real estate. And I think that's why there's such a good marriage between people in real estate and whatever aspect of real estate they're in and what we're teaching is because it kind of takes the same mentality. Would you agree to that?
Absolutely. I mean, time, money, and discipline are very important. And I think the three of those that resonates most with me is discipline.
Discipline.
I mean, you can make your model tell you whatever you want it to tell you, right?
Yeah.
If you're looking at a deal and your return's not quite as high as you want it to be, no, just lower the cap rate, right? The return goes up and problem solved. So you got to believe what you're putting in your model. So that discipline aspect is something that we really try to focus on and think about every day. It's a tough environment right now to find product that makes sense. Q1 of last year, we deployed about $30 million in total cost. And Q1 of this year, we deployed zero.
Huh.
because we were not finding stuff that made sense. And we haven't changed our underwriting parameters. We just did not see deals that met our risk return profile.
So
It's
it's
on our first deal of the year at the end of April. And that took a long time to get that one sourced. We've got some deals lined up behind that too, but deal flow's been challenging.
so it's not only discipline from your client's perspective, but it's your guys' investment discipline that has to stay true. In other words, why do a deal if it's going to lose your money?
Yeah, and people invest with us because they know, like, and trust us. They're relying on us to make decisions that are best for our investors and best for the fund, which is kind of the same thing. And that's a pretty sacred responsibility. And you have to deliver on expectations.
Hmm.
And if you're buying deals and stretching, maybe you catch some tailwinds and you get away with it, but that's not a risk we're willing to take.
Right. So, so going back just to I told you probably when we got started, I'm a bit like a squirrel. I get things that pop in my head from our conversations, and I'm just thinking, well, why do this over anything else? And you've kind of mentioned some things, but just to kind of reiterate them a little bit is like, at least what I'm hearing is that you have the ability to change your pricing. If we see inflation take off, you can adjust for that. You're not locked into a year, 5 year, 10 year contract. So that's one thing. Are you seeing price appreciation like you are in the single family units? I mean, is your price appreciation of your investments increasing at the same rate as those type of things? But why this over anything else? If you're talking to my clients out there that are listening or anybody else that's listening, why this over anything else?
Well, the three darling real estate asset classes of the last couple of years, I think, have been industrial, multifamily, and self storage. Those have been the three that have really seen a lot of price appreciation and a lot of new buyer activity that maybe wasn't there before. We carved a niche out in self storage, starting 6 years ago. And it's just been our focus. And we think that self storage is really a good blend of current yield and distributable cash flow with appreciation. Some deals out there, right, like multifamily, for example, cap rates are so compressed in multifamily. You might buy a apartment building and raise revenue incrementally over time and sell at a very low cap rate and hit a home run. But your cash flow along the way during the hold period is probably going to be lighter than a self storage facility. So we target a levered dividend yield of 8% plus rather, either at stabilization or leading up to stabilization. And that's a pretty good cash yield for a large commercial property. And then obviously we're catching appreciation and underwriting and some upside on the reversion. But yeah, I think storage is a good blend of cash flow and appreciation. And I don't know that multifamily or industrial really have both of those elements these days.
Right. And being a person that owns some rental properties myself, then you don't have to worry about the termites or the toilets, just the tenant, right?
That's right. Yeah. If someone doesn't pay, their gate access gets shut off and they get an overlock on their unit. It goes back in service for the paying customer. And if you have residential rentals, which we do in Denver, but if you have residential rentals in some of the more liberal markets, if someone doesn't pay, it might take you a year to get them out. Right.
Right.
Yeah. So San Francisco, for example, I mean, that's probably one of the worst, but yeah, it's certainly a risk in that asset class. I love residential. I think it's a core asset class where there's always going to be a need for workforce housing, but the yields in that space, if you're trying to deploy capital the last year or two, have just been very challenging.
So, yeah, I agree. So one of the questions I had from a client of mine was, he was, again, we have a tendency to really think locally when we're talking about different things. Cause he was like, well, should I be buying self-storage? Should I build one here in his town or maybe here in Fargo where I live? And so the question, it was kind of a two-part question I'd put down before I got on the call with you was, is every location a good location for a storage unit? But after starting with our conversation is that we don't necessarily have to buy into that if it is or isn't, if we can find other locations. There's nothing restricting us from working with somebody like you to find locations in other parts of the country, right?
Yeah, I'll touch on kind of our underwriting criteria that we look at when we evaluate a potential acquisition. As it relates to storage specifically, the first thing we look at is density. Is there density in that submarket? Are there rooftops? It's not so much a population or income exercise as it is just, is there residential density fairly close to the facility? The second thing we look at are supply ratios in the 1, 3, and 5 mile trade radius. So nationally, there's about 8 square feet per capita of self-storage. Historically, if you're getting well over that number, you're in a market that's getting oversupplied. And if you're under that number, the market's undersupplied and it makes sense for new development. That's still a good guiding principle, but that's kind of changed the last few years. And we've seen a lot of markets with lower rents be able to support higher supply ratios. So we're in some markets with 11 square feet per capita, which would seem high when I said the national average is 8, but the rents in those markets are pretty low. which means that more customers can afford to store. So you have more demand. So if you're considering building a facility somewhere, look for somewhere that's got some density to it, analyze the supply ratios. And then third, you have to get a good handle on market rents. So every unit in a storage facility is its own product type. So let's say you've got a unit type, it's a 10 by 10 by the front door that you drive up to is going to command a higher premium than a 10 by 10 that you have to go to an elevator, wait for the elevator, go up to the third floor, walk 100 feet. That pricing delta between those units is very different. So you want to understand what the rent comps are showing for different, not only different unit types, but what those unit types are. Are they climate controlled? Are they ground floor? Are they elevator accessed? So you have to, as you underwrite these properties, whether you're building or you're buying one, you have to look at the individual revenue streams from every one of those unit types to make an informed decision.
Gotcha. So to that point, it's not just as easy as plumping down a piece of concrete and throwing up a couple of buildings. It's really the management of the rental process. That's probably where you're going to make your money, right? I mean, anybody can do the first part. It's like having the expertise to be able to say, hey, this is the rent that needs to be charged on this unit, and an adjacent unit might be a different size, so it commands a different rent. So you have to be able to be very granular when it comes to that part of it in order to probably show the type of profit you're going to want to get out of it. Is
Yep,
that fair to say?
exactly. Every unit's its own product type. If you're building a new facility during the lease up period, you're less concerned about tweaking your revenue management, and you're more concerned about just driving occupancy. So
Mhm.
in the first year, you might be giving a big discount from market rates just to get people in there. And as you get full, then you can start kind of tweaking your revenue management algorithms to get to your maximum revenue target.
I would imagine once people are in a unit, they're not probably all that excited about moving all their stuff out for a couple bucks a month, right? I would just
Yeah, no,
from
but
my own personal
you're exactly right. I mean, if you, let's say you're paying $100 a month, you've got a 10 by 20 and you've got a house full of stuff in there and it hits your credit card every month. You don't think about it. It's kind of out of sight, out of mind. You get a $10 rate increase on that in whole dollars. That's not very much, right? And you're probably not going to move out and find a new unit because of that rate increase. And typically we'll do rate increases after some capital improvements and some rebranding the facility. So there's some value to the rate increase. But you're right. Our customer base is pretty sticky. A lot of people think they're going to store for 3 to 6 months and they end up staying for 18 months or longer.
Yeah. So is the average like 18 months for how long people stay in those rental units, or is it somewhere in that neck of the woods?
In our portfolio, it's about 30.
30.
Yeah.
Okay.
So we have a lot of small business customers. Like we have beverage vendors who go put all their Gatorade and soda in the storage unit, and they want to drive up units so they can show up with their truck and go distribute it. So it's a fairly sticky customer base.
Gotcha.
Yeah.
Which, if you think about it, that's really what you want. And in any kind of rental units you have, it's obviously getting a good tenant in and then keeping that good tenant in so you don't have to spend the money to bring somebody else back in. Like
Yep.
like with any other customer, you want them to stick around and be there and pay the ongoing revenue without really much thought or hassle. I mean, that's ultimately what you're looking for.
Exactly. Thankfully, in storage, the turn costs when a customer moves out are pretty much non-existent, unlike residential. But churn or turn in storage is not necessarily a bad thing because when a new customer moves in, let's say somebody moves out, somebody moves in, that's an opportunity to increase our asking rate a little bit and then sell that customer some of our ancillary revenue streams like tenant insurance and kind of other like boxes, tape, stuff like that. So churn in
Gotcha.
the business is not necessarily a bad thing.
Yeah, as long as you have people lined out the door waiting to get in that spot.
Yeah, if
But
you're churning and you're losing revenue, that's not a good thing. Yeah.
no, no, exactly. So, well, I look at the time. I promised you it'd be about 30 minutes. I swear we're running over that. I really appreciate it. I could probably go on for another hour. I have a lot of questions, but I do appreciate your time getting on with this. Real quick, if somebody wanted to work with your organization, again, there's a lot of organizations out there. I'm not endorsing you. All I'm saying is that if you like what you hear and you want to know more, how could they find more information about if this makes sense for those people that are listening to this that want to have some additional revenue stream and put their money to work? How could they get a hold of you?
Yeah, we're launching Fund 3 here very soon, as well as a development fund in Q3. People want to learn more or just talk shop about storage, they can go to our website, which is vanwestpartners.com. They can email me, jacob@vanwestpartners.com, or hit me on LinkedIn, Jacob Vanderslice.
Jacob Vanderslice. So one other quick question before I leave. It's kind of the Columbo thing here. One more thing, right? As people are getting educated in this space, well, it's probably a two-part question. Are there information they can read? And so just before you answer that, to your point, everything that you've heard, everything that you read is really useless until you take action. So I want to preface that question, but are there certain things that you would say, hey, if you want to know, this is a great book, or this kind of what got us onto this as I was reading this publication, or whatever it might be. And then the second part of that question is, what's your favorite book right now, or what book are you reading right now, just from your individual standpoint?
Yeah. To answer the first part of the question, a really good self-storage resource is a publication called the Self-Storage Almanac. You can Google, download it. There's a website called the Self-Storage Association. It's pretty useful. Those are good places to go just to kind of hear what's happening in the industry, learn a little bit more about the asset class. As far as books go, I got to find a new book, by the way, because I've mentioned this on numerous podcasts, but it's so good. I just can't help myself. I am not a good reader, believe it or not, of business books. I just have a hard time getting through them. So I mostly stick to a story. And one of the best books I've read in the last couple of years is a book called In the Kingdom of Ice by Hampton Sides. And it's a story of late 19th century, early 20th century polar exploration. They thought that if they went far enough north, the ice would melt. They could get over the top of the world to Asia. That didn't happen. And the survival story of these guys, some made it out, some didn't. It's just remarkable. And it certainly puts any challenges that we have in our personal or business lives on a daily basis in perspective. Right? It's like, oh, this deal didn't go. We missed this deal or whatever happened. Well, it's not like I was eating the leather off of my shoes with frostbite in the polar ice cap. So yeah, In the Kingdom of Ice is a great book. If you want a departure from business books, I ripped through it and actually gave copies to my entire office because I was just so moved by it. But
That's an interesting book. I haven't read that. Was that the bird expedition that it was chronicling, or who was the captain of the expedition that they were?
The name of the ship was the Jenny. I'm trying to
Yeah.
remember the name of the captain of the expedition. It's been a few years since I've read this.
That's right.
Actually.
Yeah.
Yeah.
I didn't mean to put you on the spot on that one.
Yeah, that's okay. Yeah. It's kind of similar to the Ernest Shackleton book.
Yeah, Shackleton. Okay.
Shackleton was Antarctica. And that's a
Yeah.
great book and great.
Yeah, they just
story.
found that ship down in the.
They just found it. Yeah. They
Yeah.
just found the Endurance. Yeah. 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 Kind of similar stories, but all of Shackleton's party made it out and all of this other guy's party didn't quite make it.
Yeah. So, well, I would encourage you, if you want a book to read, I'm gonna make Becoming Your Own Banker by R. Nelson Nash, The Infinite Banking Concept. It is a great. It's short, 65 pages. Even a guy with ADD like me can read it in one sitting. So, I end up reading it and rereading it about 30 or 40 times. But it's a great book, just kind of how people think and why what holds us back from doing a lot of different things. So that's going to be my plug. That's what I'll share with you today.
All right. I'll add that to my list.
All right. Well, Jacob, hey, I really appreciate your time. I appreciate your expertise. Again, if people want to know more, pick up the publications, go to your website, and we'll post that in the show notes as well, what the website is, if they want to know more, want to get, engage with you or your organization, if it makes sense for them. So again, thank you for your time, and good luck out there in Denver.
Yeah, Wade, great to meet you and have a good trip to Florida next week from Fargo.
Yeah, I'm looking forward to it. It's snowing here now. Hopefully it's not there when I get there. So,
All right. Thank you again.
Bye-bye. If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.